In 2025, Donald Trump basically reinvented the sales tax. He didn't do it through Congress. He didn't do it with a new line on your receipt. He did it with a national trade emergency that took the average U.S. tariff rate from roughly 2.5% to something closer to 27% in a matter of months. 70, the highest level in more than a century. Then, when markets crashed and allies started screaming, he partially walked it back, declared victory, and kept promising that tariff money would pay for tax cuts and even $2,000 checks. What he didn't say out loud is the core mechanic. You can't tax foreign goods at that scale without, in practice, taxing American consumers. Economically, they're the same thing. The only difference is whether the tax is printed on your pay stub or hidden in the price tag. Here's how the system was wired. On April 1, Trump signed an executive order using emergency powers under IEPA to declare what the White House branded Liberation Day for American trade. Under that order, starting April 5, almost every import into the United States was hit with a new 10% baseline tariff. That meant everything from phones and TVs to cars, steel, aluminum, clothing, food, and building materials suddenly had an extra 10% charge added at the border. On top of that, a second tier of so-called reciprocal tariffs between roughly the low double digits and 50% was layered onto countries with which the U.S. runs big trade deficits: Thai, China, India, parts of the EU, and others. If you're a normal person, you just heard a lot of jargon. If you think like an engineer, what you see is a global price shock built into the entire import system almost overnight. Economists calculated that when you blend all those layers together, Cindy, the new universal 10%, the higher country-specific penalties, the existing steel, aluminum, and vehicle tariffs of the average applied as tariff rate shot from about 2.5% at the start of the year to an estimated 27% by early April. That number is not just high, it's historically high. Trade historians were pointing out that you'd have to go back to the era of Smoot-Hawley in the 1930s to find anything comparable. The Fed chair described the move as significantly larger than expected, which is central bank code for "this is a live grenade in the supply chain." Within days, markets reacted exactly the way you would expect when you tell the world's biggest economy that it's putting a toll booth on almost every import. Global indices sold off. An early 2025 U.S. stock slide turned into a full-fledged correction, with analysts explicitly connecting the Liberation Day tariffs to the crash. Politically, though, Trump sold it as free money. The message from the podium and from his social posts was simple. Other countries have been cheating America. Now we're charging them reciprocal tariffs, and the billions we collect will pay for income tax cuts, factory subsidies, and even direct cash $32,000 for every low and middle income American foodie, something the White House later dubbed a tariff dividend. It sounds like a cheat code. Hurt the bad guys, send checks to the good guys, no trade-offs. The problem is that's not how tariffs actually work in the system. When a tariff hits an imported car, a smartphone, or a container of steel, the foreign government doesn't write a check to the U.S. Treasury. The importer pays the duty. The importer passes most of that cost into higher prices down the chain, manufacturers to retailers to you. By the time you're buying a truck, a washing machine, or a bag of groceries, the tariff has been baked into the sticker. Economists across the board have described these tariffs as a de facto consumption tax that lands on us households. The markets forced a reality check. Within a week, business leaders, allied governments, and even some Republican lawmakers were warning that the tariff shock, on top of existing rate hikes and a fragile affordability picture, was a recipe for recession. On April 9, Trump abruptly reversed course on most of the global hikes. In a Truth Social post, he announced a 90-day pause and said that during this period, almost all countries would face a significantly lowered reciprocal tariff of 10% instead of the higher stacked rates. In practice, that meant the U.S. still had a universal 10% tax on nearly every imported good, with some extra duties left in place on things like vehicles, steel, and aluminum. The heavily punitive country-specific rates were dialed down, especially on allies like Canada and Mexico. China tariffs in some cases were trimmed from around 20% toward 10%, but new 40% penalties were added for goods routed through third countries so-called transshipped products. So you didn't get clarity, you got complexity. The baseline stayed, but the layers above it turned into a maze of if-then rules. This Chinese input at 10%, that finished product at 25%, this transshipped category at 40%, if customs thinks you're dodging the rules. If you're a company trying to build a factory, an AI data center, or just buy components for next year's product line, that uncertainty is poison. You don't know whether your cost base will be 10% higher than last year, or 40% higher, when a new enforcement memo drops. Reports from business groups and analysts have been blunt. Firms are delaying investment, scaling back hiring, or shifting sourcing strategies just to survive the volatility. Now plug this into the affordability story you've already seen in housing and everyday life. When you put a 10% tax on almost everything that comes into the country, you're taxing the stuff people actually buy: cars, electronics, furniture, appliances, groceries, building materials, and more. You're taxing the steel and lumber that go into new homes. You're taxing the imported components in HVAC units, fridges, and washing machines that builders install in entry-level houses and apartments. You're taxing the chips and software inside the cars people need to get to work. At the same time, Trump is out in speeches telling voters that he's bringing prices down very fast and that inflation is basically over. Those two realities cannot coexist. Tariffs of this magnitude function as an extra sales tax on the middle class, layered on top of the cost of living crisis they were already feeling. Independent researchers have tried to put numbers on this. Modeling from places like Wharton and budget labs at Yale and elsewhere estimate that Trump's tariff package acts like a roughly $2,000 plus annual cost increase for the average household SUI on the order of $150. Fit $200 a month, Febby once you account for the knocking effects in goods prices. At the same time, the White House is floating the idea of sending that same household a one-time $2,000 tariff rebate, check paid out of tariff revenue. If you think like an accountant, the equation looks absurd. Raise recurring annual costs, then promise a single shot of cash that may or may not materialize, all while pretending the underlying structure is fine. That's before you even get to the fact that tariffs also hit business investment, which feeds back into growth, jobs, and wage pressure. Budget experts looking at the $2,000 check idea have been skeptical for a more basic reason. The math doesn't close. Tariffs are producing additional revenue, but not at the scale you'd need to sustainably fund universal checks, meaningful income, tax cuts, and larger-scale industrial subsidies all at once. Remember, tariff revenue rises only when imports keep flowing. If tariffs are high enough to seriously shrink imports, your war chest shrinks too. If they're low enough to keep imports strong, the inflation pass we're through stays high and households keep paying. Most of the economists who've looked at this say there's no free lunch here. You're not making foreigners pay for America's bills. You're routing a chunk of American consumer spending through us. Customs, the Treasury, and then maybe FUE after political decisions and budget fights, FUD, back to some households in the form of checks. And that's before you factor in retaliation. Other countries have already responded with their own tariffs on U.S. exports, from agriculture to manufacturing. That means soybean farmers, machinery manufacturers, and other exporters are facing higher barriers abroad, which undercuts Trump's promise that this is about bringing jobs back. Instead of a clean reshoring story, what you get is a more fractured global trading system, higher friction on both imports and exports, and a lot of uncertainty about where long-term investment will land. The bigger risk is that this becomes a permanent state rather than a temporary bargaining tactic. If you normalize emergency powers and 10% universal tariffs as just how America does trade now, the cumulative effect over a decade could be slower growth and a permanently higher cost base for everything from housing to food. From a systems design perspective, Trump's 2025 tariff emergency did three things at once. It rewired the tax mix without admitting it to shifting some of the burden from explicit income taxes to hidden consumption taxes. It increased noise and volatility in the business environment by making tomorrow's trade rules contingent on presidential mood and negotiation theatrics. And it deepened the affordability squeeze on the very middle-class households he's promising to protect, particularly those already on the edge with housing, cars, and credit card debt. The rhetoric is America first. The lived experience for a lot of people feels more like America taxed, with the bill arriving in small, deniable increments. So when you hear the next speech about factories, AI plants, and tariff billions paying for $2,000 checks and big tax cuts, run a simple test. Ask where the money actually comes from, and who ultimately pays. In 2025, the answer has been clear if you're willing to look past the flag branding. The tariff bill doesn't land in Beijing or Brussels. It lands in the shopping cart, in the contractor's invoice, in the car payment, and in the mortgage quote that suddenly looks a lot higher because the materials that built the house got more expensive. If you want to keep unpacking the Civ ID, the way emergency powers, tariffs, and free money promises are quietly rewiring the U.S. economy, hit subscribe. Drop a comment with how much your own bills have moved this year, and ask yourself one thing. Did America First actually move your costs down? Or did it just move the tax from the line labeled ERS to the one labeled Total Due?